Most people think the financial system is just banks. You deposit money, banks lend money, and the economy moves forward. But beneath the visible system, another financial machine quietly operates in the background. A system moving trillions of dollars while avoiding many of the rules traditional banks must follow. This hidden network is called shadow banking. And despite sounding mysterious, it plays a massive role in how modern finance actually works today. This surprising part? Most global financial crises cannot be fully understood without understanding this system first. Traditional banks operate under strict regulation. They accept deposits, maintain reserves, follow central bank rules, and are constantly monitored by regulators. Why? Because governments know banks are critical to economic stability. But over time, finance became more innovative. Large institutions realized they could perform many banking activities without technically being banks. And once money discovered a path around regulation, capital started flowing there rapidly. This created an entirely parallel financial system, one operating beside traditional banking rather than inside it. That parallel world is what we now call shadow banking. Shadow banking is not illegal banking. It simply refers to institutions performing bank-like functions without being regulated like banks. They still create credit. They still provide liquidity. They still finance businesses and assets. And they still use leverage to amplify returns. But unlike traditional banks, they often avoid heavy reserve requirements and strict oversight. Think of it this way. Traditional banks operate inside the official stadium. Shadow banks operate outside the stadium walls, but they are still playing the same financial game. That flexibility allows faster growth and higher profits. But it also creates much greater systemic risk. The shadow system is filled with institutions most ordinary people never directly interact with. But global markets depend on them heavily. Hedge funds use leverage and complex strategies to generate returns. Money market funds act almost like bank accounts for large investors. Private credit firms lend directly to businesses outside banks. Mortgage lenders issue loans that later get packaged and sold. Repo market participants borrow short-term money to finance long-term assets. Notice something important. None of these institutions look exactly like traditional banks. Yet collectively, they perform many of the same economic functions banks perform every day. One of the biggest drivers of shadow banking was regulation itself. After financial regulations became stricter, traditional banks faced tighter capital requirements and lending restrictions. The capital always searches for efficiency. If profits become harder inside regulated systems, money naturally moves toward less regulated areas. That is exactly what happened. Shadow institutions could lend faster, take more leverage, and generate higher returns with fewer restrictions. From an investor's perspective, this looked attractive. From a systemic perspective, it quietly moved enormous risk outside the visible banking system. Money followed flexibility, even when risk increased underneath. Today, shadow banking is deeply embedded into modern finance. In some economies, shadow credit activity rivals traditional banking itself. This system funds corporations, real estate projects, consumer loans, leveraged investing, and financial markets. In other words, huge parts of economic growth now depend on institutions outside traditional banking. This is the key insight. Modern finance expanded beyond banks long ago. When people imagine the financial system, they usually picture commercial banks. But in reality, an enormous portion of global credit now flows through shadow institutions instead. The hidden system is no longer small. It sits at the center of global capital flows. The biggest danger in shadow banking comes from liquidity mismatch. Many shadow institutions borrow money short-term but invest it long-term. During stable periods, this works smoothly. Short-term funding keeps rolling over, confidence remains high, and profits continue growing. But during panic, everything changes rapidly. Funding suddenly disappears. Liquidity freezes. Institutions are forced to sell assets quickly. And because leverage is often extremely high, even small shocks become amplified across the system. This creates a domino effect, where a funding problem can transform into a full financial crisis almost overnight. The 2008 crisis was not just a housing collapse. It was fundamentally a shadow banking crisis. Banks and financial institutions bundled mortgages into complex securities through securitization. Then leverage was layered on top of those products repeatedly. As housing prices rose, confidence remained strong. Everyone assumed the system was stable. But once mortgage defaults started increasing, trust collapsed rapidly. Nobody knew which institutions held toxic assets. Liquidity vanished. The shadow system froze. And because the global financial system was deeply interconnected, the crisis spread everywhere. This revealed how dangerous hidden leverage can become when confidence disappears. Traditional banks have emergency support systems. They can access central bank liquidity facilities. Deposits are insured. And governments often act as lenders of last resort during crises. Shadow institutions usually do not have those protections. So when panic begins, funding can disappear much faster. This creates contagion risk. One institution's collapse can spread stress across many others, because the system is highly interconnected, and regulators often struggle to even see the full extent of those connections in real time. That is why central banks worry about shadow banking so deeply. Not because it is always dangerous, but because crises inside it can escalate extremely fast. Shadow banking did not disappear after 2008. It evolved. As regulators tightened rules in one area, risk simply migrated somewhere else. Today, private credit markets are growing rapidly. Fintech lenders are replacing parts of traditional lending. Private equity firms and hedge funds increasingly perform functions once dominated by banks. The financial system constantly adapts faster than regulation can follow. That is one of the defining characteristics of modern finance. Risk rarely disappears. It usually just changes form and moves location. The shadow system keeps evolving, because global capital always searches for new pathways around constraints. Shadow banking reveals something uncomfortable about modern finance. A large portion of systemic risk exists in places most people cannot easily see. There is hidden leverage, hidden dependence on short-term funding, and hidden interconnectedness between institutions. Everything appears stable during periods of confidence, but financial fragility often remains invisible until stress exposes it. This is why markets can look perfectly healthy right before a crisis suddenly erupts. The deeper lesson is important. Financial systems are not only shaped by visible institutions like banks, they are also shaped by the invisible architecture operating underneath them. Traditional banks may hold money, but shadow banking quietly moves the modern financial system itself. It finances markets, corporations, mortgages, investments, and enormous flows of global capital. Most people never see it directly, yet the global economy depends on it every single day. And that creates a paradox. The institutions with the greatest influence on financial stability are often the ones least understood by the public. Shadow banking is not some small side system anymore. It has become one of the core foundations of modern finance, operating silently in the spaces between regulation, liquidity, leverage, and global capital flows.